Well, they corrected like just gold did. I wouldn't call it huge. I called it a needed and necessary. But here's the thing to remember now. Another quarter's gone by. They're selling gold. Imagine you're a Canadian gold producer. Gold is around $6,000 Canadian, and the biggest cost may be for a producer up there in the area of 2,000, some are below that. Man, they'll take that profit margin all day, especially when oil prices are going lower, which is one of the biggest expense, and labor costs. So the majors are in excellent shape, but what's been very pleasing for a person that made such huge bets on the junior resource end of the market, they're now stepping down aggressively and doing deals, particularly one where a Mexican major producer who had no interest in Canada up until just a couple weeks ago, and now went out and made a major purchase of a company in Quebec. So I think A, the majors are going to keep printing money. B, their stocks are going to do quite well. And C, M&A in the metals and mining industry is into its highest gear in years. Listen, first let me take a step back. After being, you couldn't have been more of an ardent bull than I was for several years. But even I felt a couple months ago we needed a correction. We were in a parabolic race. We did. We got slightly under 4,000. There was a chance talking about, it can go as low as 3,600. And Elijah, as I told you before we started recording, even I'm impressed of how well gold handled a natural needed corrective phase and has resumed its climb again. Listen, we up $100 and something yesterday. Now, granted, when gold was 2,000, that was like a $50 day. We must keep that in mind. But nevertheless, I'm not surprised today, that we opened higher, saw some follow-through buying, and then, of course, some profit taking. But nevertheless, both gold and silver, gold still leading, silver's tagging along, but both of them most impressive on how they've come through this corrective phase. And of course, they're doing this in the face of the still stiff competition. Everybody and their mother, I hope I could say it that way, Elijah, is touting Bitcoin. There isn't two posts where there isn't another Bitcoin prophecy. That they're talking trillions. The president, his kids, every bank's going to have it. There's all sorts of law, and it can't get out of its own way, and it's rolling over, which and this is all happening while gold just remains really, really strong. So I have to tell you, even I'm impressed. I thought the corrective phase could last longer. It still may back and fill here, but I think anybody that was looking for, 500 or 1,000, these people popped out of the woods all of a sudden saying it was over. We're going back down towards 2,000, but just very, very impressive so far on how gold has handled itself.
Meanwhile, other assets clamored for attention. Everywhere you looked, another piece on Bitcoin's upside, trillions in flows, banks joining in. Yet, despite all that noise, gold quietly held firm. While crypto and tech were dueling for headlines, gold stayed on its path. Even with profit-taking and headlines, the yellow metal's resilience in the face of hype and competition is remarkable. A reminder that not all value fights are loud.
I wouldn't even call it more of a correction. I think I would say, you never say never in this business, but I would say it's an 8 or 9 out of 10 chance that we've seen the lows. So, just under 3,900 maybe. Look, we just had today news. We had the ADP number, which has always been much more dependable than the government numbers. And if you think they didn't hanky-pank with the employment number before, wait till Trump has his person in there, how those numbers going to come out. But the ADP numbers today were very negative. Dollar got hit hard, a real softening economy. We're seeing a lot of geopolitical news. One of the things that I think helped turn gold around, and almost no one in the mainstream media talked about it, but not surprising, is what's happening around Venezuela. So we sent a whole bunch of military down there, and guess what? Russia and China has as well, and has been adamantly supporting the fact that the United States should not consider an attack on Venezuela. I also think the geopolitical concerns is that people witness that Trump blinked. That I felt that he went from day one the wrong way. He took a big stick into this trade war when he should have took an olive branch. And basically he blinked, especially to China. Nothing net has been gained from China. Even China today put out news that, hey, we'll give you some magnets for your civilian, but we're not going to give it to the military. Of course they're not going to give it to them. We have a defense guy that's in charge of the defense saying we're going to defend Taiwan. They're talking about one day they're going to take control of Taiwan, and they're going to send us magnets that are going to be used to help fight them. You know, it's preposterous what people don't look at in the general financial media. But I think all of this, and then just the long-term story about the change in monetary, that people are recognizing that gold's money again, that central banks are getting rid of bonds, including our own, and adding gold as a monetary base. And when you start hearing, this I think was perhaps the biggest news in weeks, when Main Street brokerage firms, and forgive me whether it was JP Morgan or somebody like that, actually started talking about taking 20% away from bonds in the 60-40 plan and going 60% equities, 20% bonds, and 20% gold. Man, if you needed anything for an early Christmas present as someone that sells gold bullion, you got it, my friend.
What else drove this ironclad bounce? First, the macro signals weakened. Soft employment figures, faltering economies, central banks under scrutiny. At the same time, geopolitics surged. From Venezuela's military posturing to tensions over Taiwan, defense commitments, strategic minerals. Simultaneously, monetary systems shifted. Central banks started cutting back bonds and adding gold to their bases. This structural underpinning is no mere backdrop. It's the stage setting for gold's performance.
Well, they correct it like just gold did. I wouldn't call it huge. I called it a needed and necessary. But here's the thing to remember now. Another quarter's gone by. They're selling gold. Imagine you're a Canadian gold producer. Gold is around $6,000 Canadian, and the biggest cost may be for a producer up there in the area of 2,000, some are below that. Man, they'll take that profit margin all day, especially when oil prices are going lower, which is one of the biggest expense, and labor costs. So the majors are in excellent shape, but what's been very pleasing for a person that made such huge bets on the junior resource end of the market, they're now stepping down aggressively and doing deals, particularly one where a Mexican major producer who had no interest in Canada up until just a couple weeks ago, and now went out and made a major purchase of a company in Quebec. So I think A, the majors are going to keep printing money. B, their stocks are going to do quite well. And C, M&A in the metals and mining industry is into its highest gear in years. Let's look at that. The last great bull market was 2010 and 11, and they are in far better financial shape then. They're not leveraged as they were then. Listen, by 2014 or 15, many of the majors were concerned we're going to be able to keep the lights on. So they are in a much better shape. Number two, they are recognizing that we are in a unique political environment where politicians who never stood next to miners and wanted to be seen with miners now openly embrace them and call for it. I'm involved in a play in British Columbia in an area that maybe 20 years ago people would say, oh, they'll never have a mine there or whatever. Now we had from the far left political arm, politically in their own house, embrace this company and tell people how important it was. So this critical mineral talk that people hear about is real. Governments, because of decades of ignoring it, and it can't happen overnight. People talking about, yeah, the United States and Canada, they can pass all the laws and put all the money aside. This isn't just something you go out, you buy it, and you start using it tomorrow. It'll take years to get to that level. And that's why the majors recognize that right now they've had cards to play unlike any other time in the 40 years I've been in this business.
For decades, Wall Street treated gold like pariah. No yields, nothing to invest in the traditional sense. Now the script is flipped. Major financial institutions are recommending 20% allocations to gold alongside equities and bonds. Producers are enjoying strong margins thanks to elevated prices and lower costs. Miners are making deals, moving into expansion mode, not retrenchment. The entire ecosystem is acting like an opening phase of a bull cycle, not the tail end of one.
If there is a melt-up, it's very thin. It's not widely participated. Again, it's basically in technology and more thinner in AI. I think we're starting to see some of the potential negative ramifications. We're starting to see, classic people who recognized bubbles before getting very negative on the AI. We're starting to see that they are performing what had happened back 20-something years ago when they start to use unique ways of financing each other to try to keep the game going. The only thing that I think that could prevent that sell-off is we're getting into a very seasonally positive period for the stock market. No charcoal wants to be seen in a stocking from about our Thanksgiving through New Year's. It tends to be a point in time when people are just merry. Now, there's been a couple times when the stock market went down in December, but basically December tends to be a good month. And here's why I think it's important to use our Thanksgiving Day for us Americans. After that, you're not going to see hedge funds making any type of bets. They've already figured out what their payout's going to be. Remember, they get paid on the performance of the year. They get the 20%. And most of them are up this year. It's been a pretty decent year for them. So I don't think they're going to be risk adverse and be heavy sellers or buyers. So I think any of the major downturns that can occur are going to occur in 2026. But let me tell you this, and you're the first interviewer I'm sharing this with. I've spoken it to my own clients and followers in recent days. I believe 2026 and 2027 will be two of the worst years in the stock market, that it'll actually be down and could be down hard to the point where cash, separate from metals, what holding for metals, is the predominant feature in the portfolios, at least to our planning group clients that I've shared. And I use this kind of analogy when they ask, well, Peter, how much should I have? Whatever your age is, that's the percentage. So in other words, if you're 30, 30% cash. You're going to be 70 like me, near 70. And the reason is if I'm right about a couple of bad years, especially for those who retire that can't afford any loss of principal, they can ill afford that and then try to somehow make it up in the latter years. So overall, we may still hang on for the balance of this year and not have any widespread decline. But I think 2026 and 2027 could be among the two worst years we've had in decades.
But here's the kicker. This is not just a U.S. story. In Asia, young consumers are buying physical gold, not merely as jewelry, but as investment. Central banks in emerging markets are accumulating at record pace. According to the World Gold Council, global central bank gold reserves recently hit more than 36,000 tons. In short, the structural shift is global and tangible. Paper games still occur in London or New York, but the real demand lies elsewhere.
Well, I don't think it's going to happen in a crash form. That's why you have that. When you have suddenly people down 20, 30, 40% and the margin department's calling you, you sell whatever you can in order to meet that. And you ask questions later. I don't think it's a crash that's going to occur, and I believe it's going to be a rollover and leakage. And there are a lot of reasons, including a loss of the political strength that Trump has had, economic weakness that's going to be really seen by everybody, civil unrest. There's a whole bunch of things now. There's actually 12 points that I've shared on why that'll be. But I think that's going to be over time, Elijah. And as long as it's over time, gold won't be sold because people have to raise money. And quite frankly, again, I want to point to what we said in the onset of this, and I may be singing to the choir, but we're seeing financial service firms. Listen, for 39 of the 40 years that I've been in this business, Wall Street treated gold like kryptonite. They didn't want to go near it. They feared it would kill them because it kills their favorite things, stocks and bonds. And now we have major financial institutions openly telling their clients to make gold part of their portfolio. So I don't know how then we have huge declines when they're first coming to this. Now, when we start going to parties and taking the Uber and the guy that's waiting on us is telling us about some hot gold stock or why you should own gold, maybe that's going to be a time when we reach the peak. But we're so far from that I'm not concerned about it at all.
So where do we go from here? Forecasts among major houses remain bullish. For example, Goldman Sachs sees potential for further upside into mid-2026, driven by central bank buying and policy easing. Timing corrections is always foolish, but at least one thing looks clear. This isn't a speculative froth topping yet. For many portfolios, especially where capital preservation matters, gold again plays a pivotal role. The key is recognizing the macro regime shift and positioning accordingly.
They won't, but there's other thing that I think is very important that I might have missed, I should have stated earlier to you, is this also, the other bullish reason for gold. Let's get out of just looking at what's happening in the U.S. in gold, and let's look what's happening in the world, particularly where there's growth in the world, predominantly on Asia. They're getting on lines to buy gold, and they're taking their weekends, young Chinese, Asian, Vietnamese, going into stores to buy physical gold, ownership of gold, not just because it's a pretty necklace, but as an investment. And what's happening on our weekends here in the U.S., Elijah? We have people going into stores to buy stuff they really don't need with money they don't have. So that's another bullish factor. And if somebody said to me, what's the single biggest difference in this global market than any others you've been in? And that is the dominant nature of the physical market. The paper hangers, the people who have manipulated, we call it the Crimex, the Comex, whatever you want to call it, out of London, New York, they're at least badly wounded, if not. Now, that doesn't mean like in the old baseball, they bring the old timers back once a year and they get their day to hit a few pitches. But I think the paper market, which we were used to and always saying, okay, it's only a matter of time till they show up, they've been destroyed. And main reason they've been destroyed is because their market has been taken away from them. Gold has moved to the Far East, and the people in the Far East have other desires to use gold other than as a paper hanging place. And that's why I think is another bullish reason why we're not going to have major downturns anytime soon in the gold market.